In this video, we're going to talk about the importance of your credit score when it comes to going to the bank for a loan. So traditional bank financing is going to a lender, asking them to give you the loan to buy your dream property that you're looking to purchase. And the bank's not just going to hand over the money very easily. They're going to need to go through a qualification process where they vet you and they check you out and they check your finances to make sure you're qualified to be able to afford the property that you're trying to purchase. So in this case, one of the things the lender's going to do is they're going to look at your credit report. They want to see what debts you currently have, what your monthly payments currently are on your credit history. They're also going to look at your credit standing. Have you been making payments on time? Are you a good person when it comes to borrowing money? Do you have good credit? And additionally, on your credit report is going to be a credit score. So lenders are going to look at your overall credit score to help determine what interest rate they're going to offer you on your loan. So when you hear about interest rates being 5%, 6%, 7%, you can get different rates kind of based off that credit score. So it's not going to fluctuate a whole lot. Like we're talking having really good credit might get you the best rate, which could be maybe 6%. So this is going to be for the best credit borrowers that can get that 6% rate. And then as your credit score goes down the sliding scale, your interest rate's going to start to slide up. So maybe if you're in the next tier down for credit, you might be offered a 6.25% rate. And if you're in the next tier lower than that, maybe they offer you 6.5%. And if you're in maybe the bottom rate where you have low quality credit, then maybe they offer you 7% because they look at you as a more risky borrower compared to someone with really good credit. So the interest rate, again, can fluctuate kind of based off that credit score. So ideally, you want to do whatever you can to try to get your credit score up as high as possible before you go through the loan qualifying process. Because the lower interest rate you earn, the lower you're going to pay in interest each year. That's going to save you lots of money over the life of your loan. So for example, a 5% loan on $100,000 would be $5,000 a year that you're paying just in interest only. If you had 6%, you're going to be paying $6,000. If you had 7%, you're going to be paying $7,000 a year in interest payments on that $100,000 loan. So you can see that's a difference of $1,000 or $2,000 depending on which rate you get per year. And if you multiply that over the course of 25, 30 years, it's going to add up to thousands of dollars that you're going to be paying extra in interest by having that higher interest rate. Now, compound this even further when we look at how much of a loan you have. So in this case, we just did a $100,000 loan for a small example, but if you've got a $300,000 or maybe a $400,000 loan, you're going to be paying $20,000 a year in interest as opposed to someone else paying $27,000, $28,000 a year in interest. So they're going to be paying an extra $8,000 more than you every year because they got the higher 7% rate than you did getting the 5% rate. So that's $8,000 extra in just interest. That's wasteful money that's just disappearing to the bank because of you having a low credit score. So keep that in mind. Save yourself thousands of dollars. Help yourself build wealth quicker by keeping more money in your pocket and not paying out so much in the form of interest. And to do this, just got to work on your credit score and get that credit score up as high as possible so you can have the best credit score when you go to qualify for the loan.